Well, the uncertainty across markets continues to increase. Blake and I go into the September central bank meetings where the Fed, the ECB, and the Bank of England are all expected to raise by up to 75 basis points. We see the US dollar continuing on its ascent. We see equity markets in decline. It's all going on. We preview it in the trade-off. Well, hi, my name is Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And we, as you can see on the side there, have a very action-packed show. I would point to exactly what's going on, but I've been told by my producer to sit still because of the lighting issues. I got told off by my producer to do so. So this is what we've got a lot to focus on today. And hopefully we cover all of those factors as we go into the themes, the setups, and all the action that's going across markets. Anyway, Blake, I'm going to bring you into the program, my good sir. How are you? Are you well?
I'm doing great. How are you, Chris? Good to see you, buddy.
Yeah, mate, I'm going well. It's just interesting because one of the things I was talking about the other day was this idea that you call yourself Pip Czar on Twitter, and I wanted to understand: is that a bullish name to call yourself? I mean, it's a bit tongue in cheek, but how did you come up with that name?
That's a great question, Chris. Back in whenever it was 2008, 2009, the U.S. car industry went under, and we had to appoint a car czar here in the United States. Well, at the same time, we had some shows called The Morning Edge, and all of the viewers had their own Pip moniker. So there's Pip Steeler, Pip Mantle, Pip this, Pip that. And I was actually the Pip Prez, because I was the president of the Forex division. And then somebody called me the Pip Czar, and it stuck like I could not shake it. So, I just kind of ran with it. And
but you know what I would call myself? I'm going to call myself the Pip Mogul. I reckon Mogul's better than Czar. What do you reckon?
Yeah, well, it's better than Pip Marmite.
I reckon that's a great place to actually start looking at what could cause the pips to move. Let's go into Topical Thunder. Well, I'm going to go into FX markets, Blake, because we can talk about the Fed in a second, and we will. But we are starting to see some moves taking place. The euro is starting to look pretty attractive against the pound, against the NOK, and against the yen. Certainly, euro sterling is making a move up. We've now got 125 basis points of hikes being priced into euro rates over the next 2 meetings. They're expected to raise 75 basis points. When was the last time you've seen the ECB? Have they ever raised 75 basis points? It's a super rate hike. We're seeing the US dollar break out against the Japanese yen here. The yen looks really weak. The NOK looks weak at the moment. We saw the Norges Bank coming out and saying they're going to be selling 3.5 billion NOK a day coming through in the FX market. That's caused the Norwegian crown to get smacked. We are seeing some big moves, but what we're seeing, Blake, is we're seeing different camps emerge, currencies that are looking relatively attractive, and clear fragility in things like the Japanese yen, the pound, and the NOK as well. So it's interesting. It's becoming, I don't want to say it's simple, but we are seeing clear consensus trades emerging.
Clarity is there. Well, let's talk about what's really clear: the dollar, right?
Yeah, right.
I mean, if you want to own something in FX, you own the dollar at least.
You probably already own it, though, don't you? Don't you own it already? I mean, it's way low. It's loved, isn't it? It's really been well owned.
It is, and I mean, it's scary but you know what also is scary is you look at the euro, and you pointed exactly right. The euro is actually looking really good against the sterling. We're getting up towards range highs. We got the Euro Aussie that's actually shown a reversal. Euro Kiwi actually looks pretty good. And actually even the Euro Mex is actually bouncing. I mean, so the euro looks great. And we've noted and talked about this before. It is scary shorting the euro near parity. I mean, you throw everything at the euro and it doesn't drop much below parity. So, and there's a lot of people that are very bearish the euro. So I think positioning is very, very short euros right now. So the risk might be that the euro squeezes, but does it really squeeze much against the dollar or like as you're pointing out, maybe against other crosses.
Well, it seems it's easier to play against the crosses, right? So, I mean, if you look at euro dollar, we've been in this kind of descending channel for most of the year, to be honest. We really need, for people who are trading euro dollar, we need to break 10080, and then we get into the top of the channel into sort of 10180. I think that's probably a momentum trade, but we need to break that top end. But the upside at the moment from a relative rates perspective is that real rates in the US, in Europe have been moving up. We've seen natural gas prices last couple of days under a bit of decline because Germany's come out and said that they're stockpiling about 80%, 85% of capacity. We've got the Nord Stream 1 closed at the moment. That's a concern for us at the moment. But I think certainly euro against some of the crosses looks quite attractive, and that's where some momentum is. But you can't bet against the dollar. Obviously, the big issue that we've got there is what happens with payrolls this Friday, and that could continue to see it going up. But 2-year treasuries now in the US, they're steamrolling. They're 350 at the moment, and that's continued to put upside in the dollar.
And people keep they keep betting again. I know we need to move along, but people keep betting against U.S. employment, and I'm not really too sure that employment's ready to roll over, but we'll see on Friday, and we're going to talk about that. We're that's coming right up.
2 steps ahead, mate. You're 2 steps ahead. Come back into the time zone.
Stay in your time zone. All right, let's talk about the Fed. Yeah. And I'm going to be the first one to admit I was actually caught wrong-footed going into Friday. I was actually short a little dollars. I was thinking that the stock market might rally a little further. As we talked about it last week, I was kind of looking for a move just above the 200-day moving average. Then I was going to fade equities up there. Yeah. Well, the market really reversed. The Fed chair was obviously very hawkish, more hawkish than the market. Well, the market was expecting a hawkish Fed, but he was really, really hawkish, and he didn't let up. And so I've got to ask, everybody's hoping, praying.
Everyone's hoping, exactly.
They're hoping for some sort of pivot. Yeah. But you got rates are pricing at 130 basis points for the remainder of the year. You've got QT starting this month. I mean, is there even a Fed pivot coming? What's the rates market telling you, Chris?
Well, the pivot is no longer rate cuts. I mean, the Fed have made it very, very clear they're not going to be cutting rates in 2023. What are we pricing now? If I look into euro dollar futures, we've got 30 basis points of cuts being priced into the latter stages of next year. That a couple of weeks ago, that was around 60 or so. So the pivot is no longer rate cuts. The pivot is that they just literally take it down from a ridiculous pace of 75 basis points into something more conventional, into 25 basis points at some stage this year. That's the pivot. But look, I mean, I think Powell, he sort of channeled his inner Ronan Keating, didn't he? And he basically said, you say it best when you say nothing at all. And he had 30 minutes to speak on Friday. He spoke for 8 minutes, and it was defined. He basically made it really clear that that there was no conjecture that you could interpret the comments as dovish in any capacity. The Fed are going after inflation, and they've made it very, very clear that's going to be the case. So if we are going to get a pivot, it's going to be just more conventional policy settings as 25 and away from 75. But the way that things are going, that we saw this week from the JOLTS report with jobs opening, 2 jobs for every one, that ratio's increased. You'd be favouring a 75 basis point hike in the 21st of September meeting. The CPI number that comes out on the 13th of September maybe could seal the deal there. Obviously, the equity market wants to see that headline number coming lower. But my base case at the moment, I think most people's base case is that they go 75 basis points in that September meeting. And, it's going to be a lively one because the Bank of England, they probably will go 50, but there's a small chance they raise 75. The ECB now, when their meeting comes up on the 9th of September, it's pretty much a given to me that they're going to raise 75 basis points, which is crazy. The Australian Central Bank was going to raise 50 at the next meeting. Canadians will probably go 75. So it's a blockbuster month, isn't it? For
it is. And could you imagine the market cheering if the Fed only raised by 50 basis points?
This is the world. This is we discount 75, and that's the perversity of this situation. But what's interesting here, Blake, and I'm sure you've been talking this with the Forex analytics clients, is that bad news is firmly good news for markets, and good news is bad news there. So, when we talk about things, and let's go into the payrolls, because this is a perfect segue to see that. because, if you have a look at the way that we traded on the JOLTS report, when the job openings came through this week from the US, 11.2 million job openings. It was about 850,000 jobs openings above what the market was expecting. What happened when you do that? People coming out and saying, that's fantastic. It's so good. We're going to see all these jobs. Equity markets got slammed. The dollar rallied and treasuries sold off and yields moved higher because the market is saying, what are we looking for right now? We want to see what the Fed are seeing as the signals to ease back. And that means that we're going to need to see a cooling of the labor market, and we need to see headline inflation moving back towards core, and core ultimately finding signs that at some stage in the next couple of years it's going to move back to target. So we know what the signals are that the Fed are looking for, and therefore we cheer when we see a softening in the labor market. And if we go in, I know it's the perversity of the situation, but we saw that from the JOLTS report. The JOLTS report said that this was an incredible level of job openings, and we sold risk on the back of it. So when we go into the payrolls number on Friday, the market's looking for 300,000 jobs. They're looking for the unemployment rate to stay as it is, and we're looking for for average hourly earnings to probably go up about 5.3%. That is a very strong level of job creation, and that should seal a 75 basis point hike. The irony here for me, Blake, is if we were to get a really strong number, say 400,000 or above, equities are going to get smacked. And to the average person on the street, you say, what? Here's the NASDAQ 100. If we were to create 400,000 jobs in the payrolls report, what would you expect to see with the equity market? They'd say, it's going to go up. So this is the perversity we have now, isn't it? The bad news or good news is bad for the equity market and good for the dollar.
It is. And so I wanted to ask you, we had the ADP, it got retooled, remastered. And it came out today. It came in a little soft compared to what? I mean, but the number came in at 132,000. What do you make of the new ADP? Are you even looking into it? Is it anything that's a factor to you now with non-farm?
Yeah, I mean, it's been such a poor predictor, but let's say this new methodology is actually more correlated with the BLS model. We saw 132,000 jobs. The market was looking for 300,000. Now, actually, what's more important, if you take the 12-month average, which they came through on the ADP number, and the 12-month average is 356,000 jobs. And let's work on this assumption that it underreports relative to the payrolls number. The payrolls number has sort of been going at a 12-month monthly average of 495,000. So if we get the average of the ADP, it's 356. The average of the payrolls is 495. And we use this number that we've seen from the ADP number at 132. It probably gets us to where the expectations of the market is around 300,000. Yeah. So that would probably be, if you were to go out and go, what's the whisper number on the street, this nonsense number that comes through, 300,000 seems, if you use that methodology from the ADP, where the market would be pricing this. So the playbook for me on non-farm payrolls is simple. Below 150,000, below 100,000 net jobs, and the dollar will sell off. Equity markets will probably rally. Above 400,000, and you're going to get risk coming off. The dollar will rally, dollar yen will break through convincingly through those levels. That's the way I'm looking at this as well. And I think it gets another segue into that, because obviously we're trading the payrolls number, but we are seeing lower levels today. Blake, I'm looking at Asia. We've got NASDAQ futures down about 94 basis points. NVIDIA have just come out with news because of what's happening in China of sales guidance lower. And NVIDIA is down about 6% post-market. That's taking futures down, techs down, Qs will probably open up lower. But equity markets generally have been trending lower. What's your take on the equity markets, and which one are you looking at specifically there?
Well, let's talk about the equity markets. We're going to turn our attention to, I just wanted to ask the question, are we headed to retest the 2022 lows? It's a scary thought because the markets opened the year at the highs of the year, and we've been down quite substantially throughout the course of the year. But, after hearing the Fed chair and how diligently the Fed is going to be fighting inflation and trying to get inflation back down to their 2%, which is going to be interesting to watch to see if they will be successful.
You and I are going to be retired, mate. It's going to be 2024. We're going to be lounging, drinking cocktails on some beach in Hawaii, I reckon.
Right. Give me another Mai Tai. But technicals, I mean, let's talk about it, because the S&P, could not break above the 200-day moving average,
No,
right?
yeah.
The Dow failed to break above the 200-day moving average. The S&P is only at 7% off the lows. That's not very far. That's a hop, skip, and a jump away.
We're at 61% retracement now, and with the if that 19% rally we saw between June and August, we're about pretty much into that 61% level. Is that right?
Well, yeah. So that was up on an escalator, down on an elevator. That's the
right.
price action, right? We were there within 3 days. I mean, that's how fast we've dropped.
Yeah.
The IWM, remember, I brought up the chart 2 weeks ago about the failed breakout. Well, it failed, right? It also failed at the 200 DMA. NASDAQ couldn't even get up. The NASDAQ 100 couldn't even get up to the 200 DMA. The DAX stalled at the 38% retracement, which is a bearish continuation Fibonacci level. If you can only reach the 38% retracement on a bounce, that's not a good sign for bulls. The CAC 40, the French market, it failed at the 200-day moving average. The Nikkei continues to move lower. China and Hong Kong, those markets look horrible. We're not far away from the 2022 lows. And even the FTSE that's been, I don't know why, it's been holding up so well this whole year. It's actually starting to look kind of weak over the last few days. So are we going to retest these lows, Chris? I mean, what are your thoughts on markets? I think they look scary to me.
Well, yeah, I mean, I think we've got this support on the NASDAQ and around and S&P into current levels into that 61% retracement. But
sure.
I think I wouldn't want to be long at the moment. You're catching a falling knife. It feels like you need some consolidation. You need to show some buying pressure coming through. Obviously you can scalp in and out of that situation. But yeah, if you're trading off 4-hour or daily charts, the trend is your friend in this situation. You're catching a falling knife. You're either out the market, in my opinion, or you're short. So that seems to be the high probability trade at the moment. I think, the other way you can play this is the ASX and the FTSE have outperformed, in my opinion. Not just because of currency effect, but because they are all value markets. They have a very high dividending yield relative to other places. So when bond markets are going up, they get less affected by the discounting mechanism, the present value effect that happens from rates moving up. So you could play this by being long the ASX, short the NASDAQ. Those kind of plays, trading relative value, trading long, short, that's a way to do it. But if you're looking at the big ticket items at the moment, the trend is your friend. I wouldn't want to necessarily buying on a 4-hour time frame or a daily chart until you see some consolidation and showing that the market looks like it wants to stage a higher bid though. So there's a lot of uncertainty. When you get this kind of uncertainty, the buyers are staying aside. We're getting CTAs drip feeding more length on the short side, and that repositioning is coming down. So I still think, Blake, for me, it's continued to be a bit cautious in this market. So I think that's the way I'm looking at it, and it feels like that's the way you're looking at it as well. So I think let's go into the technicals and have a look at some of the setups that are on our mind at the moment. Well, the first one I'm looking at, Blake, is what's happening in SpotCrude. And I mean, you can see this is just a crazy move, right? I mean, we're just trying to bring up the chart now, but
while you're doing that, that was gnarly. That was a gnarly move. It was a nasty reversal this week. So
gnarly. Is there a time in life?
That's a California term.
Is there a time in life when you should not be allowed to use words like gnarly? Is there
over the age of 70? In my book,
it's just like skateboards, isn't it? It's like at the age of 40, you should not be allowed to be on a skateboard unless you are like Tony Hawk, for example, who can pull it off. But Blake, I mean, just gnarly. Come on, mate. Anyway, whatever. You saw that move up, didn't you? You saw the wedge, you saw the breakout. Everyone was getting bullish, including myself. I was thinking this is going to go up and test $100. The next candle, as you can see there, we made a higher high, and just from that very moment, the sellers just came in, bang. You're not going up, you're going down. We saw an engulfing pattern, and we followed through quite aggressively. And it looks like we're going to go back and test those recent lows there. So we can talk about fundamentals. The cows come home, because there are some very bullish fundamentals. We've heard from OPEC last night talking about next year's deficit coming through. They've cut their surplus for this year by half, and we can talk about what's happening with supply issues. And we could make an argument that if we get back into those lows, then we're going to find some support. But the price action at the moment continues to suggest that the demand issue from falling economics continues to be one of the big issues there. So you're surprised, I'm surprised. Where do you see this going now?
Well, false breakouts usually lead to breakdowns. That's a good rule of thumb that's always, kept me safe in the market. And so technically I still target $75. And when I have random people that just, blurt out to me, crude will never see 75 again, then it's like I start to get a little nervous, and which did happen recently. And so, it doesn't look good for bulls. And I understand the argument. We understand the bullish argument, but price action is king at this point.
Yeah, right. Absolutely. 100%.
All right. Well, speaking of price action, let's take a look at gold, because I want to do a little gold digging there, Chris. We're gonna dig for gold. What are you doing later tonight? I'm just kidding, joking. I'm joking.
I'll be sleeping. So
hey, look, I know a lot of you guys and gals are precious metal and gold bulls, and we've been watching precious metals, and I mean, frankly, the price action's been pretty bearish. However, the bear flag pattern that I have, you can see it outlined in red. It does target the 1780 level once again. Now, as you know, the 1780 level has been really a nice level to be on the long side. I mean, but it also is starting to get riskier because we're making lower highs, that there are stops situated below the level, below that 1780 level. And to be honest, I mean, that's the target. And if you want to go gold digging and you want to be on the long side, that might be a place to be long with a tight stop. But
do you mean 1680? You mean 1680?
1680. I'm sorry. I said it was saying 1780. 1680. Sorry, I don't have the chart in front of me. I'm just looking at our screen. So, 1680. It's been a really key level. You can see it highlighted in that green. And if you want to be long down there, you know where your stops need to be. But I would definitely. Well, you should always have stops in the market, but you got to keep them tight because they might get targeted. What do you think, Chris? Well,
it always comes down to your strategy. We give these daily charts, weekly charts, because it's good oversights. But obviously, if you're day trading, if you're scalping in and out, you're swing trading, momentum, mean reversion, all that sort of stuff. That's up to you. But what you're working with is a downtrend at the moment. So for me, when I'm trading intraday, my natural bias at the moment, given that we've seen 3 red candles and that all the moving averages are aligned, price and the rate of change is the downside, is that the probability is this does go down to test that 1678, 1680 level that you talk about. How price reacts into that's obviously something that we'll have to look at, and that's something that we trade. But for now, if I'm looking at the big picture situation for the time frame that we trade in and out of, is that the rate of capital is moving down. We've got real rates on 2s moving further higher, which is negative for gold. The dollar is weighing on gold. So I feel like this. I feel like the probability is this goes further lower. And the other one, of course, is you can see there, dollar yen is the next one, because of course when we're talking about gold, we've got to take a view on the dollar, and dollar yen is just one way of expressing what we're seeing there. And dollar yen, this chart is something that we pulled out about an hour and a half ago. Since that time now, we are seeing a breakout. So we're now seeing 139.62 is the level that we're looking at. So that top has broken out. Now, obviously, this is a daily chart, so we need to see a close above those July highs. And that would give us a really clear assumption that the bulls are in control of this move. So I always like to wait for the daily candle to close, because sometimes you get the pin bar reversals playing through, and that can be powerful in itself. But as it stands at this stage, we've got a breakout in dollar yen. And of course, the question is will we see 140? And then what does the Bank of Japan and the Ministry of Finance do about that situation? It feels like we're trending again, doesn't it, Blake? And money can be made very well when in trending markets.
And the Bank of Japan's Kuroda had nothing to say regarding the yen and the weakness that we saw in the yen over the weekend. So that, I think, just opened the door for fresh lows in the yen and highs in the dollar yen. And Chris, I've got targets that go up to 142, 144, but when something starts really breaking out and you get this momentum behind it, I mean, who knows? I mean, those targets become more like speed bumps in the market, and it looks bullish right now. Yeah, so I think you've got to respect it. My colleague, Dale Pinkert, he interviewed Adam Button from Forex Live last week. Yeah. And he said one of the biggest developments that he's seen in 2022 is just recently the yen break away from the risk on, risk off model. We have stocks going down, as you pointed out earlier in the show. they're down significantly because of NVIDIA.
It's a bond proxy. It's just a bond proxy.
It definitely is, because the yen's not catching the risk off bid, and that's that breakaway is significant. It's something we need to be respectful of.
But if the risk off vibe is being driven by higher bond prices and by bond yields, lower bond prices, then the yen, if we saw a situation where growth was the issue and bonds were getting bid and yields were going lower, then I think the Japanese yen would probably work in that situation. But what you're seeing is bond yields are moving higher again, and that to me is just, where do you want to park your capital? Is you don't really want to be in the Japanese market, because the Bank of Japan's still got their ultra dovish policy setting. So as long as bond yields are going up and equities are going down, then the yen's it's not going to work, because you're just paying carry effectively in that situation.
It is, and the dollar yen looks great, Chris. I love this chart. Speaking of a chart, I wanted to bring to your attention is the Aussie Kiwi. I know we have the RBA early next week, but look, you thought I was going to come in today being an Aussie bull. You even said it last week. Next week, Blake, you're going to come in being an Aussie bull.
It's changed.
It's against the Kiwi, and I'm showing you just some technicals that I think are really important. We've been in this bullish channel. I actually played the Aussie Kiwi on the long side 2 weeks ago on this breakout, and I made really great money. But I haven't played since it's reversed, but we're right back at the breakout point right now, Chris. That comes in around the 111.80 level. But I want to note the highs that have been made in price and the highs that have been made in relative strength. And when relative strength shows a peak, price peaks. And it's done it so consistently in this chart on the daily chart. So we have the RBA on Monday. I think if we get a solid break back below 111.50, I think it trades back towards 110.70, 110.60. What are your thoughts with the Aussie Kiwi here? It's starting to look a little toppy.
Yeah, it's a tough one. And the RBA meeting for everyone else who lives in Australia is on Tuesday. Blake's a different time zone, obviously. For me, it's a tough one. There's things to dislike about both currencies, but it feels like the downside is more prevalent. And I think you probably at a sort of a higher probability suggest maybe see this trading down to 111. I haven't had my sell signals yet that I like to look at from a more systematic perspective, but they're not a million miles off. And when they do, I'll probably be trading this from the short side for 111, 110.50. And maybe the RBA meeting comes out and suggests, but given what we saw the other day from retail sales in Australia, which were ridiculous, then you suggest that the RBA shouldn't see any reason to be dovish in any capacity. So from that perspective, it's difficult to make a fundamental assessment the RBA is going to cause this pair to go down. But look, at the end of the day, rates are fully priced. A 50 basis point hike from the RBA is fully discounted. We've got a fairly rich curve that the RBA need to live up to. So it's an interesting cross. We've actually got a lot of client activity in this pair, and most of it's on the short side now. So I favour that side of things. It's a good chart, and I'm thankful you brought it up. But for me, 111 is the higher probability for me.
All right. Well, there you go.
Anyway, so maybe that could have been a really good play of the day, but it isn't. And that's a setup that Blake's got up. I want to hear what Blake has as his play of the day. Blake, I'm going to take the liberty of going to my play of the day first of all, because that's the.
You know what? You should. It's your show. You should.
We've had a couple of good questions from viewers. Mike Burberry, he wrote a really good question. He actually thought crude could go higher, but one of the things he talked about was the idea about commodity prices, and certainly in the more sort of agricultural side of things. One of the ones I want to touch on, which was one that he didn't bring up, but it is wheat. And why did I bring it up? Because you've seen that really strong consolidation for a large period of time. The Bollinger Bands have come into this big squeeze. You can see that the moving averages, the rate of change is sort of doing not a lot at the moment. And I look at a market like wheat, and when you get a long extended period of consolidation, eventually that breaks out and it will create a massive trend. And it does trend beautifully. So I've got this on the radar. There's no trade at the moment. But when you see those Bollinger Bands squeeze sufficiently, when it breaks out to the top side, that to me is a momentum trade that turns into a trend trade. It's on my high watch alert, because you don't see squeezes for this period of time. And I think once it breaks out, that will be something that I'll be jumping on. And so, yeah, it's one that's firmly on the radar for a potential trending vehicle situation there.
That is a nice consolidation right there. So I like it, Chris. Well, you were talking earlier about the bullishness of the euro and how well it's looking. Well, take a look at the euro yen. That's going to be my play of the day.
Yep.
The euro yen is actually breaking out to the upside, and it's continuing this upside break because this is a daily chart. It is an image. The yen is weakening. The dollar yen is breaking out. So obviously it's taking the euro yen with it. It broke out of a triangle consolidation, and that the maximum target of that triangle consolidation takes us all the way up to 142, which is near the 78% retracement of the entire down move. And you can see also recent highs that came in mid-July, right around that same area. So being that the euro is looking a little bit better on the crosses, the yen is weak, and remember, Chris pointed out that euro strength on the crosses. The yen is weak, as he also pointed out in the dollar yen. Well, hell, put them both together, and we got the euro yen today. So the euro yen, I think, looks bullish, and I think we target 140, at least 140, and going up to 142. And it looks like it's going to squeeze, Chris. I like it.
I like it too, mate. So I like it when you get yourself together. You get yourself a trade.
Yeah, that's right.
But yeah, all good. Anyway, if you're still watching the show, we really appreciate it. If you can hit the like button, we'd appreciate that as well. We got some really good comments last week. I talked about Mike Burberry's comments there. So yeah, do leave your comments in there, Blake, and I'll get to those as we can, and we might be able to address some of those going into the show ahead. For all you fathers out there in Australia and that part of the world, happy Father's Day for the weekend, and we appreciate you viewing. We'll see you next week for more of the trade-off.